Hello and welcome to day 13 of my ICT trading journal to help me with my learning understanding of ICT concepts. Today we're going to do three things. We're going to have another even more in-depth look at higher time frame PD arrays and try and understand how that gives us a narrative when we go down to a 3 minute. We'll do a quick recap of the trading demo backtesting, obviously not real trades, that we did for the 15th. And if we zoom in on this candle here, I've already got it annotated and saved so we can have a look at that. So just to give you some context, this green box that you're seeing here would be this daily fair value gap, and although you can't quite see it here, just off top to the left, price would be coming from the volume imbalance here. So we were rejecting off here, coming into this daily fair value gap, creating equal lows, and that gave us a sort of bullish bias or a suspicion that price was going to respect that fair value gap. Based on two things: yes, daily fair value gap, and also lots of equal lows formed over 3 days. So I've just annotated my thoughts here, so it's a bit more concise. Daily bias, price had rejected daily fair value gap multiple times, creating equal lows, purging London liquidity, resting underneath buy side. I noticed sell side liquidity resting above, and that would be up here, sell side liquidity here. So we anticipated a Judas swing below the equal lows. First, the algorithm would need to take those equal lows to then take price higher as a requirement for bullish order flow. So in order to enter a buy position, the requirement was that we had to have the Judas swing taking the equal lows. This is something I sort of added, hindsight, original consolidation. So I don't fully understand how price moves from one thing to another, but I've seen ICT talking about original consolidation. We're kind of paying attention to how we get these sort of equal, this kind of smooth level here that kind of gives us a hint that price is consolidating, and then it breaks consolidation once price gets to this level here. Price broke out of original consolidation, leaving displacement, which would be these fair value gaps. The London lows were violated, so it entered a small long targeting internal range liquidity. Now, if you watch the video, I didn't actually do that. We kind of identified this, even had this trade on the chart, but once I saw price coming back down, I kind of took it off at the last minute, and it never got filled. But I'm writing this journal from the perspective of what I did right. It's I don't want to kind of reinforce negative thinking in a journal. So, and while waiting for the daily equal lows to be swept and a Judas swing to the downside. Okay, so that happened. In an ideal world, we would have, following the rules and everything, we would have, we were right to be concerned about price rejecting these equal highs, but we only really needed to worry if we saw price break through liquidity and then come back the other way. That wasn't a sufficient purge of liquidity, whereas this was. So this is where your being a buyer would no longer be valid until these lows were taken. Once internal sell-side liquidity was taken, I avoided taking any more long positions, which of course I didn't do. Of course I did put on a long position, got stopped out, and that was a loss, until the daily equal lows were taken, reasoning that major buy-side liquidity resided below, which it did. Price retraced back to a 15-minute fair value gap within a discount, and I learned to trust and submit to the higher time frame PD arrays, which is something I'm been struggling with, and the narrative I had mapped out around price delivery. But your analysis is going to be much better than snap decisions in the moment based on emotions. I closed the position at the end of the PM session this one actually did happen. This you know, legitimately did get this right. The whole idea is when I come back a week from now to review this, I'm not going to be reading about how I screwed up and didn't miss a trade and stuff. And you know, it's supposed to like, yeah, reinforce positive learning and everything. Okay, so yeah, that's the recap there. Yeah, and after I was done there, I came out here and just decided, as an exercise, I was going to try and... What the hell? Just heard a loud bang outside. Bin must have been blown over. Yeah, I just wanted to try and identify as many of these PD arrays as I can on a daily time frame, because as anyone who's tried trading before, we know how difficult daily bias can be. So we... and also, I also realised that once again, I'd got my understanding of breakers completely back to front. You see, I had been seeing breakers as something like this, where I see that, I'd be like, okay, that's the high, that's a low, that's a high. Hang on a second, let me just do that again. Let's do that. Okay, yeah, so I see price making, you know, doing its thing, and then all of a sudden we get a lower low, which creates that market structure shift. And what I used to think was that the breaker was this, and then we'd enter a buy position once price went into the breaker and then went through it. That must be some other type of thing that I... because that's completely wrong. The whole point is that price will retrace into an area like this and then continue to the downside. So, you know, yeah, whatever I talked about regarding breakers in any video prior to this one is pretty much completely wrong. So, but I've corrected my rules and everything here. I've like... It changes around. I just had to go back into the ICT videos, into the core content, looking at breakers again. So the reason I did this is to try and make sure that I'm understanding the breakers. Sorry, I know I could do a box around there, but I'm lazy. Okay, so we'll try and understand the narrative here. Okay, so why don't we do something like, yeah, we'll do something like this. Okay, so we're looking at this, and we can see a fair value gap here, a bullish breaker, because I just keep forgetting it. High, low, higher, high. High, high, low, high, high. It's so simple, but I just keep messing it up. High, low, higher, high. The final up leg in price that formed the high, okay, which would be these green candles, and I'm using the bodies of the candles because they're just a bit more significant than wicks. Final up leg in price to form the high, that's it. That is the breaker, okay, and the midpoint of the breaker is fairly significant. What we'd be anticipating now is that, you know, if price comes down here, would be expecting price to do something like this, basically. We don't know when that's going to happen, but, you know, it's just another piece of the puzzle. So price is actually, I mean, I haven't annotated the entire history of the Nasdaq here, so we're gonna go from here. Okay, so price. So let's say, you know, we would come trading here. We're looking at this. We've seen price rejecting this BISI, so that would give us like a bullish bias, wouldn't it? There's probably some equal highs off to the left that I can't see. Sorry, I kind of jumped the gun there. Once we'd seen the fair value gap get traded into like that, we'd be anticipating bullish price. Yeah, I think just wicking into it just isn't, you know, because it wicks into it, then price goes away, then it comes back in and fills it. So try and keep that in mind for future. Okay, do I remember what an order block was? Significant low broken, that'd be here. Bearish candles prior to a rally. So we wouldn't be recognizing this an order block just yet. We would be kind of, you know, making note that this candle's closed above there. Once we see something like this and we see that displacement, that's everything we need for an order block. So now we would be anticipating that, you know, oh, we've got another fair value gap here. Price might want to come back down into that order block. Doesn't mean it is, but I mean if it does, then we would be expecting some kind of reaction from there. Okay, and that's what it does. Taps it, comes down, you know. Clearly that level is, you know, something's happening there that's making the algorithm go down to that level. Okay, and at this point we'd be seeing these highs and seeing that's the next draw on liquidity. We don't know how far price is going to go up. So price trades into this fair value gap. We're kind of expecting this to get filled and then for price to kind of move away from it, aren't we? That's what we like to see happen. Nice to see the PD array being respected. Then we've created this sell side imbalance, a SIBI, fair value gap SIBI. So we expect, well, we anticipate that price might want to go there, but of course we don't know for sure because there is this fair value gap here and everything, and you know, we are anticipating price to come down here at some point. So you know, it's giving us clues of what it's going to do, but not everything. What are we seeing here? We're seeing a high, a low. You know, I'm guessing there'd be some sort of sell side liquidity. Maybe we're kind of reaching some kind of significant level. So maybe we'd be, you know, expecting, you know, when is the market going to reverse? It's been going up and up and up and up and up. You know, markets do tend to, you know, reverse at some point. So every time we see a major high and a low being created, we're going to take note of that. Got a low there. Actually, we've got a low, high, low. No breaker yet. Get a low. Then a high. It trades into that SIBI. Then we get a volume imbalance. We get a strong kind of candle that goes through there, and at this point here we now have a low, a high, and a lower low. A bearish breaker is a low, a high, a lower low, the final down leg in price that forms the low, and I'm going to be using the bodies of the candles, paying attention to the mean threshold here. So the whole idea is that, like, well, if we do come to the chart and we see price rejecting off of here, then we can be, you know, have a pretty strong suspicion that we're going to be bearish. Oh, and of course here, the bearish order block. Close, where is that? I have to look at the 2022 one, don't I? Significant high broken. That'd be here. Bullish candles, bullish candle here prior to a price drop. The reason I say drop is because it has to be a sudden drop that creates displacement, you know. Once price closes below there, we have overlapping PD arrays. Now we have a bearish order block and a bearish breaker, and even though I haven't marked it on the chart, a sell side imbalance here. So now we have 3 PD arrays, and everyone can see price goes back up there. excuse me. I remember we're waiting for, you know, price to make that lower low. We don't know what the low of the lower low is going to be yet, but we were able to put the breaker here. So, you know, maybe we don't use it for like, each one of these is a day, isn't it? So we can kind of reference this breaker throughout like the next like week. Looks like price is actually heading back to this bullish breaker here. Okay, so maybe we weren't sure how far this was going to go down, but once we see this, we should look closely to see if price, you know, rejects this on the next day. Okay, so after seeing something like that, the body here respects the order block, the wick respects the mean threshold of the bullish breaker. That's, you know, probably be looking at long positions. Trading up to here. Do have a fair value gap here, so probably might want to go and fill that at some point. Okay, goes to that sell side liquidity, then comes back into the fair value gap. Now would definitely be bullish, wouldn't we? Because now we've got, you know, buy side imbalance, bullish order block, bullish breaker, taken buy side liquidity here, and we've even had a market structure shift, so that's 5 PD arrays, and we get a very strong bullish move here. So I kind of like to see that if we can, it's like the more of those PD arrays we have overlapping each other, the stronger our conviction can be that price is going to go up. And now, rather than just thinking is it going to go to the moon, we start coming back into this bearish breaker again. So maybe we'll get like a body respecting this order block. Okay, wicks into the, so remember this is a whole day, so if you were trading here, once price got to here, would be, you know, looking for short positions, and there'd be a higher chance of us being on the right side of the market that way. Okay, I'm going to kind of go through this a little bit faster now, rather than trying to explain everything. We see equal highs being made here. Why is that an order block? Significant high was broken. It would be this high here. And then the bullish candle prior to a price drop. Okay, so yes, we could use this candle here as an order block, but you know, once price goes through there, creates this sell side imbalance here, and kind of looks like it's going to the downside. The chances of price coming back up here less likely, but we can also use this as well because that is also a bullish candle prior to a price drop that creates a displacement, a change in the state of delivery as price starts making a market structure shift, and a previous high, aka liquidity, was taken. So, you know, the order block is it's versatile, so it can be a bit more difficult to state with conviction what is and isn't an order block, but that's why it's good to sort of keep expanding your understanding of the PD arrays. So I'm not expecting price to bounce off of this breaker again, because we already delivered from here. Now we're delivering from here. So where's the next level that price is going to go? You know, well, there's the big fair value gap here, so oh, look at that. It comes back up to that order block we were talking about, and comes back to the SIBI. When we get one single fair value gap here a down leg in price, that one becomes more significant. Price goes into it, comes down to this bullish breaker from May. So we're using a PD array in May. We'd be looking at this, and if we didn't have this here, we really just have we'd just think it would just keep going forever. And then when it suddenly reverses on us, we wouldn't really understand why that's happening. But having this here would allow you to look for long positions here when maybe everyone else is trying to sell. So we've got sell side liquidity here, sell side liquidity here, equal highs here, sell side liquidity here, daily volume imbalance, equal highs, and then finally a major high here. So that's, there's a lot of places price might want to go, whereas here there's we've rejected off that breaker. That's the most significant thing we have to work with. Okay, so we've had a look at, hopefully that helps. And of course, if you like me, struggle to understand a particular PD array, just keep watching ICT videos on it. And so then to really try and hammer home the understanding of breakers, I'm going to review 4 back tests that I've done just using breakers, basically. This isn't me trying to show off, oh look at these trades I took. This was literally just me in hindsight trying to find these breakers and then seeing how well price respected them. And I want to see breakers on a 15-minute, because if you go down to a 3-minute, you could start seeing highs and lows everywhere and stuff. So okay, so here we've got, let's review how did we get into this trade is what I'm basically trying to do. Okay, so that's the start of the morning session. We have a low here. We have obviously we wouldn't trade during economic calendar events, but I just wanted to I'm just looking at the bearish breaker. I'm not trading this as if it was for real. So we got a low, a high, and then a lower low. The final down leg in price that formed the low, not the lower low, but the low. Well, that would be this candle here. Okay, so we have a bearish breaker. And let's go through these rules. So sell side has to be taken, liquidity, so that's equal highs being taken. Market structure shift, that happens here. Then we need a singular inversion fair value gap. We have this one here. Price must retrace into a breaker, which is what it's doing there. And although I haven't written this very well, by writing singular inversion fair value gap, that means we have to enter within. I should probably write enter within inversion fair value gap. So let's drop down to a 3-minute and see, we've got our inversion fair. So I guess technically then, once we saw this lower low, I mean, I actually kind of wanted to see price. I mean, yeah, we could have entered here, I guess. I kind of wanted to see price properly leave the breaker and come back into it. But whatever, price would just about get us into the trade there, and that would work. But let's say we didn't. Let's say we were okay. Looking at this, we weren't really sure. We weren't really sure if this was price, you know, for whatever reason. We just hesitated, and then we see price makes a lower low, and then we come back out here and start saying, oh, did we get the breaker wrong maybe? Okay, so now this is the low, low, high, lower low. So, well, that's fine. We'll just use these candles as the breaker then. And now all we're saying is that price needs to come back into the breaker, trade into an inversion fair value gap. So when I'm looking for the inversion fair value gap, you know, I'd be on the 3 minute. You know, I'd obviously see one here, but then I'd go up to a 5 minute and say, is it still visible in the 5 minute? If so, is it still visible in the 15 minute? If so, is it still visible in the 1 hour? On the 1 hour it disappears. So then we go back to the 15 minute and say that's the most significant singular inversion fair value gap there is. And then as long as our stop loss can be above the breaker, we simply enter within that inversion fair value gap, assuming price wants to return to it. Because if we do something like this, I'm just using the bodies here because that massive wick was sort of more to do with just some crazy volume from a news event, so I'm kind of just using the high here. So yeah, as long as it's, you know, within a discount. Let's say, you know, we kind of hesitated, we didn't take the morning one. At this point price does leave that breaker, come back into it. We don't get in the trade there though, do we? And we wait for lunch, and yeah, that, oh, here we go. Okay, yeah, so okay, this was the morning one. Sorry, I know I'm confusing you a bit. We have the inversion fair value gap here. Price leaves the breaker, comes back into it, wicks into the inversion fair value gap. That gives us our trade. If we missed this one, then we look for a singular inversion fair value gap in the most recent price run, you know, using the most recent high and market structure shift low to just find, you know, the premium and discount area of this price run here. And so we're looking for an inversion fair value gap within here. Start off on a 3 minute. There's one there. There's also one there as well, so we have to keep going up until there's just one. So there's one there, two, so go up again until we only have one inversion fair value gap, and then we use that one. And then, since this breaker here we never entered at that one, now we're using this one. When price came down and made a lower low beneath there, then we started using this as the breaker. We enter within the inversion fair value gap, but the stop loss has to at least encompass the breaker. So for example, we can't do this because price might want to come to the mean threshold of the breaker here and then go right through it. So we have to at least account for the fact that price might want to retrace into the breaker there. And in this example, actually, that never happens. So in this example, it's a bit of a bad example, actually, to start with. Following these rules, we would have gotten here, and then we could have gotten here, but price never gave us the entry that we needed. But I just wanted to keep it realistic. Like not everything is going to go 100% according to plan. And so then with this one, we have a bullish breaker. So that's the high, a low, and a higher high. High, low, higher, high. Final up leg in price that formed this high. The final up leg in price, that's here. That's our 15-minute bullish breaker, so I'll put that in orange. Okay, and then we have to find a single inversion fair value gap. Remember, these are traditional fair value gaps, and we're looking for inversion fair value gaps, and we've got an inversion fair value gap here. So once we had our 15-minute breaker, we would then, we'd see, oh, we got 1, 2, 3, 4 inversion fair value gaps. So which one do you use? Go to the 5-minute. There's still 2 of them. Go to the 15-minute. The higher the time frame, the more reliable the PD array becomes. We only have 1 there. Okay, so then provided that our stop loss can be below this breaker here, provided the stop loss can be below the breaker, so we're at this point we're hoping for the best case scenario possible. That is, price is going to use this bullish breaker to send price higher, but we're asking for the best case scenario possible where it actually comes through here, violates it just enough to tap into this inversion fair value gap, which has already been violated. See, so price already closed above in the inversion gap here, so this has already been violated. So if we were hoping that price was going to use that to go lower, that we've already been proved wrong. Price has already created a higher high after taking out, liquidity. That's another thing with the breaker. Like, it has to be some context of liquidity being taken out of the market. This would be one of those trades where we're like, oh, we might not actually get this one, but price just about to the tick fills us. It'd probably be permissible just to give it a couple of pips of wiggle room, Yeah, maybe just a couple of pips, just in case price, just in case there's a spread, your broker doesn't quite fill you, or something like that. Okay, and then where is price going to go to? Well, the way we do that is when we're trying to find the premium and discount of where to enter, we do the low to the high. So we got this, the low, high. We're in this up leg in price. If price wants to retrace, we want it to come at least below the midpoint into an area that would be considered a discount. But when we're actually then trying to calculate the profit target, we actually use the low, not the market structure shift high, but the level in which it became a market structure shift. So once price came above here, this became a market structure shift. That was the level in which price created that market structure shift, and that gives us a target that actually lines up nicely with our daily volume imbalance. So if we were trying to, know, well, is there a reason for price to go there? Well, we've got a higher time frame PD array to aim for. And this would be one of those trades where I probably wouldn't be able to take it because it's at the very end of the PM session at 6. And so what actually happens is we have to basically wait overnight going into London before that target actually gets hit. So wouldn't actually be the type of trade we could take. The first one was during a news event, and I said I wasn't going to trade news. This one, we only got the entry at the end of the PM session, and I said I'm not an overnight trader. I wouldn't be able to go to sleep knowing there was an open trade. So, this isn't me saying, oh, look how successful I would be. This is we're just trying to test the theory behind it. And if I just cherry pick 2 examples, that's not really enough, so that's why I have 4 here. Okay, so we're looking at this. Say we're looking at, we see price, takes out the liquidity here. You know, if we come out to the daily, we're probably rejecting off of one of those bullish breakers or one of those higher time frame PD arrays that I was showing you before. So we're already sort of trying to find evidence that price is going to go higher. So we get a high, a low. Now we're looking at this to see if it creates a higher high. Once that happens, then we can look at the final up leg in price that formed the high. Not the higher high, but just the high. And that gives us a nice small area to work with. Whatever I was doing originally with breakers made absolutely no sense at all. I'm surprised it worked in the few examples I tried. Okay, then we also have to find the inversion fair value gap. Now, rather than going, I already know that the 15-minute one is the most significant one here. The whole reason behind this is you have to actually be able to explain it and understand why it's happening. So maybe on a higher time frame, we're delivering from, say, this 4-hour fair value gap. Then price on a lower time frame takes out equal lows, so it has the liquidity it wanted. We have an inversion fair value gap here that then gets violated. That's already been violated. Actually, I just realized something. We've got 2, haven't we? We've got 2 inversion fair value gaps, and we actually said we need to keep going up into higher time frames until we only have 1. So let's go to 30-minute. We've got 1. Let's see if it's still there on an hourly. So yeah, it is on an hourly, so we have to actually keep going up in the time frames and using the highest time frame. So if we use the hourly, we actually refine it to something like this. And we don't really need to go any higher than that, to be honest. So then we'll come back down to the 3-minute now. We've got our hourly inversion fair value gap, which has already been violated. We have the higher high. We don't take trades during the lunch session. I'm not going to change that rule for anything. And instead, we simply wait until lunch is over. And we even, I mean, technically, if we're really impatient, we really believe this is going to work, then yeah, we could enter now. But I want to kind of wait until. See, if we enter now, let's do the worst case scenario. Let's say we just get really impatient. And we enter at the worst area, which would be here. Okay, the trade still works, but if we'd waited until the PM session, we could have actually improved the entry, done something like this, taken less heat on the trade. And now I have this crazy profit target, and that's because if we come out to the 15-minute and we measure the breaker, which was the high, low, higher, high, we're going from, so for the projection we're going to take the low, just the bodies of the low, and then the high. Or I think what I might have done is just looked at the wicks. Really should use the bodies actually, because that gives you a more conservative target based on where the candle's actually closed, whereas this one gives you a more ambitious target based on the wicks. And to get to that target, you have to wait overnight and then price exceeds it. So, you know, so far this seems to be working out. It seems like there might be something to this breaker thing. Realistically though, if we did enter here, we would just be aiming for the high. We'd probably be aiming for this and probably just fall just short of it. But in any case, it does eventually hit our profit target. So I don't know how many examples you want me to show, how many it's going to take to be convincing enough. Okay, so let's do one more example that I was able to find at least. And yes, I have cherry picked these examples. Okay, I'm not trying to sell you on this. I'm trying to just, you know, just trying to understand it. So, okay, we think we're looking for sell opportunities based on all of these equal highs being taken out. Okay, so that's kind of given us a premise. Sort of a, you know, assuming we got the bias correct, assuming we know we're going to be looking for, you know, short positions having a bearish bias. So we're already looking at this as a low, a high that takes out liquidity, and then a lower low, and then the final down leg in price that formed the low, a final down leg in price. So a bit of a larger area to work with this time. This time it's something more like this. So once we've created this lower low, at that point, then we're looking for inversion fair value gaps that have been violated, which means we're looking for the green ones. So we've got this one here. So price goes back up above there. Let's just remind ourselves of what we're expecting to happen. We're expecting price to do something like this. That's what we're expecting to do, and that would kind of make sense, wouldn't it? Because we've got that 4-hour fair value gap. So, you know, just so we're not completely aiming in the dark. But we have two inversion fair value gaps, so we have to go to, say, 30-minute. At this point they become 1. Then let's go up to an hourly. See, okay, it disappears on an hourly, so we'll use the 30-minute. And we'll come back down to the 3-minute. Price has left the breaker. Now at this point, we have a narrative now. Price is going to come down to here, but there is a reason for it to come back to here. And maybe you're looking at this through the 2022 model, and you're seeing this as a sell side imbalance, which is fine. And remember, our model is sell side liquidity taken equal lows, market structure shift. Wait, hang on a second. No, I got this wrong, didn't I? Sell side liquidity taken via equal highs, and we actually do have equal highs there. Equal highs are a key giveaway that it's liquidity. Market structure shift here. Okay, so we have that. A singular inversion fair value gap. We had to go up to a 30-minute time frame to find that. Price has violated that gap, so if any hope we had of using that to go higher is gone. Price retraces back into the breaker, and This is saying we need to have our stop loss, what, above the breaker? Well, we're not going to be able to do that, are we? This might be one of those trades where we are not able to get filled. Low, high, lower low, final down leg in price. Well, yeah, we have to do that. We have to assume that that's the midpoint, isn't it? I mean, well, let's just play it out. Okay, so we've got a high here, but we have to assume that the worst case scenario is price comes up to here, makes a market structure shift high, and maybe even taps into the top of this fair value gap breaker. And we've seen price do that before. We've seen price in other trade examples actually go through the breaker before really using it as a platform. So we have to understand that that's a possibility. So that's the PM session. Okay, price comes into our inversion fair value gap. That's where we want to enter. Yeah, and unfortunately, you know, as a consequence of us only being able to use a small stop loss, you know, this time I wasn't able to do, because I said I've only got 18 pips, not 27 pips, not 42 pips, but 18, and I have to have the stop loss. Stop loss has to at least cover the, to be safe, you know. So yep, that one doesn't get filled, but at least the method behind the understanding is correct. How far is it going to go? How far is it going to go? From the high, not the market structure shift low, but just the point at which it made the low, and we'll just use the bodies to get the conservative target. The target lines up with the 4-hour fair value gap. Ooh, does it get it? Does it get it? Yeah, okay, it does. So there are going to be times like this, but I don't know. I think it, you know, at least you could have the consolation prize of knowing that you were able to read the market, you know. I'm just trying to see if we miss this, could we then, is there any other way to get in here using the same strategy? Low, okay, so we had low, high, lower, low. Missed that. Low, high, lower, low. Nah, I don't think. I mean, I guess you could. Now, to be honest, I stuck to my rules. I mean, with the price went where it was predicted to go on all of the examples, and in 2 of those examples, we didn't actually get filled, which is fine. But the whole point, it was just to demonstrate the breaker in effect. So okay, I think we're going to wrap things up there for now. Let me know if you have any questions. Thanks for watching. Bye.